Hi everyone, good morning. So today we will be starting with valuation question and answers, advanced question and answers. These are more advanced questions that cover industry specific valuation in more detail, as well as scenarios like IPO valuation, merger and acquisition premiums, and future share prices analysis that are not likely to come up in entry level interviews, uh, but if you are appearing for advanced positions, then these kind of questions might come. Or if someone from up in the hierarchy, partner level partner level interviews, these kind of questions can come. So let's get started with our question and answers. These questions and answers actually require a lot of deep thinking. So before you answer any of the questions, Uh, just make sure that you have watched all the previous question and answers, all the series, so that you have your fundamentals cleared. So let's move to question number one. All right. So question number one is asking how to value banks and financial institutions. And if you remember previously, so banks and other financial institutions are valued differently from traditional companies because their business models, financial statements, and capital structure operates in unique ways. So interest income is a core component of revenue that functions as a raw material rather than simple leverage, and regulatory capital requirements make book value a meaningful measure of worth. So here there is this table which I have created for you guys for better understanding. So if we do relative valuation of a bank, previously we have discussed this. While the method, public comparables and precedent analysis are same as for other sectors, the screening criteria, metric, and valuation multiples differ for banking. So screening, in addition to capital marketing and geography, you often screen based on total assets, deposits, or loan portfolio to ensure comparability. And the key metrics, instead of revenue and EBITDA, you focus on return on equity, return on assets, book value, tangible book values, and all in case of banking and other financial institutions. And valuation multiples, the most relevant valuation multiples for a banking or financial institutions are price to earnings, price to book value, and price to total book value rather than enterprise value to EBITDA. Since enterprise value is not meaningful when debt is an integral when debt is integral to operations rather than a source of financing. And if we were to do a DCF, DCF will not be suitable for bank, as defining free cash flow is difficult when working capital and debt behaves differently. Instead of intrinsic value relies on two specialized approaches. So when we are working on a bank, so we will try to apply dividend discount model or residual income model. So dividend discount model values the bank by discounting the expected future cash flows. So expected future dividends, not cash flows, but the future dividends to shareholders, and adding the present value of the terminal value, often based on terminal price to book value or price to total book value multiples. This will make more sense if we actually worked on a bank model. So in interview, when you are verbally answering, so you need to know all these things. But when this will give you better clarity, this all these statements will give you better clarity if you have already worked on a financial modeling case. So and So in banks, two types of valuations can be done, like dividend discount model and residual income model. So when we do a residual income model for a bank, we start with the current book value of equity and add the present value of future excess returns, where excess returns is actually the ROE minus cost of equity, and we multiply it with book value. So, and why these methods are used is because debt is operational, book value is meaningless, So book value is actually meaningful in case of a bank. And the capital, because of capital regulation, because ROE and book value matter directly to management and investors, because regulations constrain them. Regulation constrain how much leverage and risk can be taken. So basically, uh, valuing bank require a shift in mindset from focusing on cash flow and enterprise value to focusing on return on equity, book value, and dividends. So you use price to earnings, book value, and price to total book value ratios, multiples for comparables, and rely on dividend discount or residual income model for intrinsic valuation. So let's discuss this aspect, normal companies, and so so revenue. If you look a bank from a revenue aspect, uh, so how it's different from novel company and banking and financial institutions, that this table is differentiating a novel company from bank and financial institutions. So revenue from selling the a novel company generates revenue from selling goods and services, and bank actually generates revenue from interest income, fees, and trading and lending. So this is the difference in generation of revenue. If we think from the perspective of debt, so normal companies use debt mainly for financing leverage. But a bank actually, for a bank, debt is considered as a raw material this, because as a raw material, because this is the raw material, and on this raw material, bank actually generates interest income, fees and lending, trading. So this is actually the product for the bank. Debt is actually a product of a bank. Depositing and borrowing, fund lending. So that's why. Uh, think about cash flow. So can calculate free cash flow, but what's cash flow in perspective of bank and financial institution? It's actually hard to define free cash flow, since changes in working capital and debt are part of operations. And if we were to calculate free cash flow, because working capital and debt are parts of operations, in the free cash flow calculation, we will not be able to justify our cash flow. Regulations, for normal companies, there are minimal regulations, but banks and financial institutions are highly regulated by capital and liquidity requirements. Assets are property, plant and equipment, and inventory, etc. But for a bank, the assets are loan and securities that generate interest. It does make sense. And for book value, if you look at it from a perspective of a normal company and from a perspective of bank, so book value is often less meaningful. But book value for a bank is very meaningful, closely tied to the market value. And previously also, see, valuing bank require a shift in the mindset from focusing on cash flows and enterprise value to focusing on return on equity, book value, and dividends. And that's why we use key valuation multiples. For normal companies, we can use enterprise value, EBITDA, and price to earnings. But for banks, we actually use price to earnings, price to book value, and price to total book value ratios. Core metrics are, for normal companies, these are revenue, EBITDA, and free cash flow. But the core metrics for a bank are return on equity, return on asset, book value, and total book value. Intrinsic valuation, we can do a DCF, free cash flow method for normal companies. But for banks, we rely on dividend discount model or residual income model. Discount rate is weighted average cost of capital, but excluding the debt component, we discount a bank or financial institution on the cost of equity. So this is the rate, the discount rate when valuing a bank. And why debt? Why? So basically, weighted average cost of capital is the weighted average cost of equity plus weighted average cost of debt. But here in this case, we are actually neglecting debt, cost of debt aspect. Why different? Because debt is equal to leverage, but here the debt is equal to raw material, and this is the source of funding also in a bank. You need to be crystal clear with your concepts of finances when you are valuing a bank and financial institution, or this was an industry specific question. So you need to be aware about all the norms, all the regulations, and if you are looking for an advanced position in valuations. And this is a very this is very commonly asked question when when a senior position holder asks you, because banks and financial institutions are treated very differently, and not all, I mean, a very few people know about these things about banks. Right. So this is going to be a big reading. I will suggest you to revisit this reading and just listen to the explanation one more time. Read this thing, read this explanation, and listen to what I have explained one more time, so you can grasp it better. So let's move to question number two. So question number two is about IPO valuation, the initial public offering. So here you are describing a logic of how investment banker and equity capital market teams value companies ahead of an initial public offering. So when valuing a company preparing for an IPO, the objective is to estimate the per share price range that public market investors would be willing to pay once the company starts trading. So the process is similar to standard valuation, but with a very few key differences, because the goal is to align with public market comparables and investor sentiments. So this stock is not trading as of now. So first step is to pick company comps, which means that unlike merger and acquisition or private valuations, IPO focuses exclusively on public trading peers, companies that are already listed and operating, and they operate in the same industry with similar growth prospects, margins, and business models. So we will look at the peer companies first. The comparable multiples, we need to gather the comparable multiples, and private company data is not used because the IPO buyer universe is made up of public investors who benchmark valuation to public peers. So, for example, if you think about it, if you are talking about Stripe if we are taking Stripe public, company Stripe or XYZ company, we might compare it with the PayPal or Block Square or other companies which are of the similar peer group. And the second point here is apply relevant multiples. So next, we need to pick the valuation multiples that best describe how investors price companies in that sector. So if it's a mature company or profitable firm, we will use enterprise value to EBITDA or price to earnings. For high growth or unprofitable tech firms, we use enterprise value to revenue. So enterprise value or equity value, it depends. So we compute trading comparable multiples and take an appropriate median range. Then we apply that multiple to a company's financial metric like projected EBITDA or revenue to estimate its enterprise value or equity value, depending on which multiple you used. So, uh, and the third point, when we are talking about IPOs, initial public offerings, we move enterprise value to we actually because as of now we do not have the data to collect, because there was no the main component of enterprise value was uh, market cap. So market cap cannot be calculated. So we actually move from enterprise value to equity value. So once enterprise value is converted to equity value, so what we can do is we can calculate the equity value. So how will we do that? So we will subtract enterprise value, so debt from enterprise value, and we can calculate equity value in these cases, because net debt is debt minus cash. So that's what I said, net debt. So, however, in IPO, we adjust IPO processing because the company will receive new cash from the offerings. And then, in case of an IPO, also, so there was pre-money equity value concept and post-money equity concepts also. So, pre-money and post-money is like so. If I were to, I mean, when bankers talk about subtracting IPO proceeds, they usually mean that you do not double count that new cash when comparing to public peers. basically. So the proceeds are new and not part of the current equity value here in the in part question number three. And after that, how do we calculate the per share count? So we will divide the total shares to get the IPO per share count. So finally, determining the per share value by dividing the appropriate equity value, pre or post money, depending on the context. I mean, by the total number of shares outstanding after the IPO, which include existing shares or newly issued shares in the offering. And there is also an alternative path using an equity-based multiple. If you use a price to earning ratio in or other equity-based multiple, your starting point would be directly from equity value, not enterprise value. And in that case, what we can do is you can apply the multiple to get equity value directly. So you will compare the equity value of different companies, then you will apply the multiple directly. So you will get the equity value, then you will subtract the IPO proceedings if you want the pre-money valuation, and then you finally divide it by the total post-IPO number of shares. So number of shares actually do matter in this case because we are calculating per share data. So number of share count should be uh, taken in consideration. Uh, let's do a example for this now, because it will be it will be a better approach if we can do example. So let's do a quick example. So comparable enterprise value to revenue ratio, we are assuming that the multiple is 10x, and the company revenue is $2 billion. So the enterprise value is going to be $20 billion. This is in the denominator. So the if the company revenue is this much, so enterprise value will come here and multiply with enter. So enterprise value will multiply. So 10 times. So enterprise value will get 20 times, 20 billions of the revenue. What does this means? This formula means we have previously discussed that per $1 revenue, what is the multiple that the investors are going to uh, pay? So this 10x means for $1 revenue, the investors are assuming the enterprise value is 10x. So that's how we have calculated this. So enterprise value is now $20 billion. So debt, we are assuming $2 billion. Cash, we are assuming $1 billion. So the net debt will be $1 billion. We will subtract cash from the debt, and this is the net debt. IPO proceedings, $2 billion. This is IPO proceedings, $2 billion. So post money IPO shares and the post money IPO shares are 500 million shares. So this data is given to us. So how will we calculate the pre-money equity value? So pre-money equity value we will and we will use enterprise value. We will subtract the net debt from the enterprise value. This is the pre-money valuation. And post money valuation, because there is an IPO proceeds of $2 billion. So post-money equity valuation is 19 plus $2 billion. So that's $21 billion. This is how an IPO is calculated. IPO per share price is 21 billion. We will divide it by 500. So this will give us a $42 per share valuation of an IPO. So basically, we are comparing the peers and we are getting a multiple of 10x. Our company revenue is $2 billion. We generated the enterprise value based on the peer company analysis. This is our enterprise value. The debt, cash, we calculated the net debt, IPO proceedings, IPO proceeds, and post IPO shares. IPO proceeds, whether IPO proceeds, it could be negative or positive. It depends on if you are oversubscribed or undersubscribed. At times, it's negative also. So just remember this thing. Because you have seen this example, I hope in future it will be easy for you to understand how to do an IPO. So comparison, first you need to comparison, you need to get a multiple of the same industry and the same peers who are in the same business models, company size, geography, and all. After that, you need the enterprise value first. So enterprise value, you subtract everything, all the everything that could help you with your valuation. So you have paid, you have now you have the control over the firm. So you can use the cash to pay off its debt. So now your debt reduced. This and IPO proceeds, you are expecting an IPO proceeds of $2 billion. Pre-money, because pre-money your debt is still $1. So what they are assuming is your pre-money valuations is 19 billion, but post-money they are post money, so you have proceeds, you are oversubscribed and hence plus positive proceeds. So you actually gained $2 billion post money equity valuation, and you when you divide it by the number of shares, you get your per share price. Calculating the IPO number, always pay attention to the number of shares also. This is very important. Don't rely on the data, just do some digging. In India, it's red herring prospect, and in US, they release an IPO S1 reports. S1, I assume. Yes, S1 reports. So go through all those reports and make better decisions while valuing a company in practice. We will do that also later on, but as of now, I just want you to understand the basics first. So when you test n concept, we do questions. So what we are doing is we are doing it backwards. So we are first testing our concepts, how much knowledge do we have and where do we have to dig in, and then we will do practical questions, practical models. I hope you will like this approach. This was invented by me only. So all right. So read the explanation given in the answer. In an IPO valuation, our goal is to estimate what public investors would be willing to pay for a company's shares once it starts trading. The process is similar to a normal valuation, but with one key difference. We focus only on public company comparables. All right. So I hope this makes sense. We only focus on public company comparables since IPO market, because our company is not listed as of now. Since the IPO market benchmarks valuation is how similar companies trade in the public market. So step one is to pick the right public comparables, ideally companies in the same industry with same size, growth, and margin. Step two is to choose the most relevant multiple for the sector. For example, enterprise value to revenue for high growth tech, or enterprise value to EBITDA for mature company and businesses. So we chose enterprise value to revenue for high growth. We were assuming that the previous company was high growth, and that's what the example was based on. If we say that it was a mature company, then we will try to we will look into enterprise value to EBITDA multiple and apply the multiple to company's metric to get an implied enterprise value. And since we are talking about enterprise value to EBITDA, I have shown you that in US companies, they do not report out EBITDA numbers in their income statement. So we actually have to calculate the EBITDA numbers by ourselves, and this is also a challenge. Uh, so we actually have to adjust everything. And step three, we move from enterprise value to equity value by subtracting net debt. But because the company is raising new cash in the IPO, we also subtract the IPO proceeds when calculating the pre-money valuation, since that's new cash that does not yet exist on the balance sheet. Finally, we divide the equity value by a total number of shares outstanding after the IPO that includes both existing and newly issued shares to get the implied IPO per share. And when people say the IPO is priced at $25, that means that the per share value is implied in this process. I hope this was crystal clear to you guys. And if still you have any doubts, you are welcome to post your questions in the comment section. I'm trying to make a bot. I mean, I'm trying to make a, I'm trying to organize some event also. So in future, if we will do a live chat so that all your questions could be answered live. All right. So that's future. That's in the future. We will discuss. Let's focus on what we are doing right now. So question number three. Okay. So question number three is asking you about calendarization. So calendarization. What does calendarization mean? So calendarization. Let's read the question first. I'm looking at a financial data for a public company comparable, and it's April Q2 right now. Walk me through how you would calendarize this company's financial statement to show trailing 12-month balance, trailing 12 months, as opposed to just last fiscal year. So the formula for this trailing 12-month most recent fiscal plus new partial period minus old partial period. And let me just show you on the Excel how do you calculate trailing 12-month. Two, three, four, FY, and this repeats again. Okay, this let's assume this is 2023, 2023. This one is 2024, and this one is 2025. So what does trailing 12 months mean? Let's do a little formatting so that it looks better. Okay, and let me do one thing. Okay, so I'm assuming that these are the numbers. I'm assuming 100, 120, 130, 170 are the numbers reported by the company. And I'm assuming 200, 312, just random numbers. And I'm assuming here 304, 528, 365, and 220. We know that Fy is going to be the sum of all four numbers, all four. And let's do this. So what the question was asking is, if I were to calculate trailing 12-month balance, trailing 12-month balance is nothing but, all right, just give me one moment. I'm sharing my screen back again. So here, trailing 12-month, how do you find that? Most recent fiscal year, we add the partial period and we subtract the old partial period. Most recent fiscal year, here is the most recent fiscal year. If I am in quarter number two, so most recent fiscal year, I will add this number and I will add this number and I will subtract this number. here for this. Now look at the formula. In the most recent year, I will subtract 200 out of it and I will add 304. So this will give me 1522. This is basically 12 months. And if you look at the sum, it's 1522. If I were in this quarter and they are asking me to give trailing 12-month balance, what I will do is I will add this recent fiscal, I will add the current 2 quarters, and I will subtract the previous 2 quarters. So this will give me, so basically this is 3 months, this is 3 months, this is third quarter, this is fourth quarter, these are 12 quarters. So this will give me 1738 and this is 1738. So this is what the question is basically asking. Every quarter I want you to calculate trailing 12-month balances. But just be aware that here it's 12-month balance. Here, if I were to calculate 12-month balance, this is 1522. If I were to calculate 12-month balance in this quarter, I will actually have to exclude quarter one and two from the previous year, and I will include quarter one and two in the recent year. So this will give me 1738. And I think this cannot be more simple than this. Most recent fiscal year, you will add the new partial period and you will subtract the old partial period. Most recent fiscal year, we are adding the most recent partial periods and we are subtracting the previous periods. And that's pretty much it. I hope question number three, I do not need to explain. Let's move to question number four. So walk me through an M&A premium analysis. So if you were doing an M&A merger and acquisition premium analysis, so here the goal of a M&A premium analysis is to assess how much acquirer have typically paid above the target of the companies. I mean, this unaffects the share price in similar transactions, but this helps estimate a reasonable acquisition price for a potential target in a live or hypothetical deals. So what do you do is, I mean, so in M&A premium analysis, you estimate how much the acquirer typically pays above a target's unaffected share price in comparable deals. And you then select transaction, gather data, and you calculate premiums. So how it's done? Let me just pause. Give me a minute. So let's discuss it one more time. So, merger and acquisition premium. So the goal of the merger and acquisition premium analysis is to assess how much acquirer have typically paid over the target companies. And this is done by first we will select the relevant precedent analysis. So precedent transactions. And usually we select them from industry job based on industry criteria will be industry, geography, deal size, date, range. Then you will gather the price data for each target company. I mean, for precedent transaction, record the purchase price per share. Then you obtain the target's unaffected share price at a specific interval before the announcement date, and most commonly 1 day, 20 day, or 60 day in that interval. Uh, then you calculate the premium, and calculating the premium is of you divide the offer price per share divided by the unaffected price per share, and you subtract -1, so that offer price minus unaffected share price divided by unaffected share price. So for example, if I were to give you an example, I would say that target price is $10 one day before announcement, and the acquirer paid $15. The 1 day premium is $50. So if you repeat this on day 1, day 20, and day 60, then you will be able to calculate the premium. So 1 day premium is 50, then 20-day premium and 60-day premium. That's how you can calculate the premium and analyze. Then later, the after all everything, then you analyze the analyze and summarize the data. Uh, that's how in I mean. In short, if I had to tell you, an M&A premium analysis quantifies how much acquirer have historically paid above unaffected market prices for comparable targets. I mean, this helping estimate a realistic acquisition price target for a public company. And M&A premium analysis actually is quite tricky in theory. So, uh, okay, just give me a moment. I will show you how to do M&A. So we have discussed 4 points here. So what you actually have to do is you actually have to select transactions first. So you will identify uh, precedent M&A deals in the same industry, region, and size. So for example, I am taking 1 billion market cap and for the past 2 3 years. So and previously we have discussed that M&A merger and acquisition deals are done for short period of time. So we are taking only data for the past 2 to 3 years. Then we will gather data for each target, and we will record the offer price per share. So what people are offering, and its unaffected share price 1 day, 20 day, and 60 day before announcement. Then we will calculate the premium. And how we'll calculate the premium? We'll compute the 1 day, 20 day, and 60-day premium using this formula. So premium is offered what the price is being offered and unaffected share price. We will subtract the unaffected share price from offer price, and we'll subtract divided by unaffected share price. And example here is that if 15 is the offer price and 10 is the share price, and this gives us 50% premium. So M&A premium analysis, how much above the unaffected share price is the so this unaffected share price is what we have calculated, and how much the other people are actually offering us. So we have calculated that this should be the price, and as per the market and as per those who are actually interested in the bidding, they are offering us 15 per dollar. So our valuation, we do not disclose it as per as per unaffected share price. If you have done a merger acquisition for a purpose of selling it later on, so unaffected share price is what we have calculated and what the others are offering, internal and external. Then you get a 50% premium. If the deal is happening for a 50% premium, then you analyze and apply. You find the median premiums across transactions, then you apply them to your target's current and historical price to estimate the likely acquisition price range. And this analysis only applies to public companies only. Since private firms don't have market prices, the set transaction may overlap with precedent and transactions, but is often broader for better data coverage. I hope this makes sense. And the key point here is that this analysis only applies to public companies since private firms don't have the observable share prices. So you are comparing public companies with your company. And that's one of the limitation also. Uh, the the set of transactions might overlap with your precedent transaction analysis, but it's often broader to capture more data. And you should also consider market conditions like premium tend to be higher in stock market and lower when volatile or uncertainty is high. We have discussed it previously also. So merger and acquisition premiums are affected as per the market conditions if it's a booming economy or it's a downturn in the economy. And it actually helps us determine the reasonable acquisition price range by looking at what the premium have been paid in comparable public company deals. So in public company deals, we are taking it as a reference and we are valuing our own company. It is a way to gauge buyers' behavior and market expectations also in supplementing other valuation methods like trading comps and precedent transactions. So that's pretty much it about merger and acquisition premiums in practice. To gather data is actually very big of a challenge. So we will be doing analysis of the data or peers, so then you will understand how much difficult is to get high quality data. So let's move to question number five. Question number five is about future share price analysis, and future share price analysis is actually to project a company's future share prices. You follow a multi-step approach that combine market comparables with the discounted cash flow principles. Then the steps are to identify an appropriate valuation benchmark first. So look at a set of comparable public companies in the same sector and calculate their median historical price to earnings first. And this is based on usually trailing 12-month data, which we have previously discussed calendarization. And then the company's future earning EPS, usually 1 to 2 years forward, based on financial modeling and growth assumptions. Then multiply the projected EPS by selecting PE multiples to derive the implied future price. So future share price analysis is a step. I mean, the goal of a future share price analysis is to estimate what company's stock could be worth in 1 to 2 years, basically, and then discount that back to the present value. So this process involves actually identify the relevant P multiples first, price to earning multiples first. Then you actually project the future share prices and discount to present value, and then conduct a sensitivity analysis. So how do you identify the relevant P multiples? And basically you gather comparable public companies data in the same industry. Then you calculate the median and historical PE ratio, which is usually using a trailing 12-month figures. And this serves as a benchmark for valuing the company. And the second, pro- we have calculated once we have gathered the relevant PE multiple ratios, then we project the future share prices. When we apply the P multiple of company projected here and forward and implied future share prices. So future share prices is how much estimating the company's earning for the target future of 1 to 2 years forward. So in future, we are targeting it. We are forecasting 2 years of 2 years into the future share prices. And then how do we, how do we do is we multiply the projected PE, we'll multiply with the PE multiple, and this will give us future share price, and then we will discount it to the present from 1 to 2, we will bring it to back to this point 0. So we'll select a appropriate discount rate and generally based on the company's cost of equity, and we will discount it back to the future share price. And we will then conduct a sensitivity analysis. So considering the range of PE multiples and discount rates for the market uncertainty and valuation risk. And we'll construct a sensitivity table showing how the present value changes with different assumptions, helping stakeholders understand potential upside and downside scenarios. So that's pretty much it. How do we do a future share price analysis? And think about it. Uh, Comparable transaction and precedent, comparable precedent and DCF. So if you are doing a share price analysis, you will first compare the price to earning ratios. Then you will set up a standard. Then you will multiply that benchmark with your EPS. Then you will forecast it in the future. Then you will bring it back to the point 0. And then you will do a sensitivity analysis on at what PE multiple and what discount rate I can get the best share. What should be the scenario? The sensitivity analysis will help us to understand how sensitive is our growth with respect to our price to earnings and cost of equity. So these questions actually require a very deep thinking. Uh, Usually I make 10 questions in one lecture. This time I think 5 questions will be more than enough to understand because these are advanced valuation questions. So question number 5 to 10 we will do in next reading. All right, then. If you have any doubts, please feel free to reach out to me in the comment section and I will make sure to answer all your queries so that it gets clear. So basically, what we are trying to do is we are trying to clear our fundamentals before we start the real game. So when we will do valuation, I will show you whole valuation of different companies and different type of valuations. IP, we will do IPOs also. Uh, And if you have learned something of value today, just subscribe to my channel and like or post comments on my channel. Thank you.